Hi, everybody. Welcome to another episode of the 7-Minute Takeover, where we chat all things acquisitions. We're your hosts. I'm Liz Prey.
I'm Eamon Gamble.
Today's episode is a Mythbuster where we crack down on one of the common assumptions that acquisition entrepreneurs have in their back pocket. So today we're chatting about how the cash flow figure that's provided by the seller or the seller's broker to you, is it the real figure and true depiction of the company's cash flow? So typically this cash flow figure is arrived at by starting with the net income on the historical profit and loss statements. And then there are certain normalizations or adjustments that are made to this figure that can make the company look substantially more profitable than it was on the profit and loss statements. And so these are referred to as add backs. So Eamon, why don't you kick us off and start by explaining what is an add back?
Yeah, thanks, Liz. So it's exactly how Liz described it. So an add back is where you go from net income, even to get to EBITDA from net income, you've got to add back interest, taxes, depreciation, and amortization. So all of those are industry standard. Everybody understands the value of those add backs.
And that gets you to EBITDA.
And that gets you to EBITDA. And then from there, often a seller or a broker may say, well, actually, there were a bunch of other expenses that we ran through the company that are not necessary for the continued success of the business, or certain expenses were paid to, say, owners in the form of compensation that didn't need to actually be paid. And so what they'll do is they'll say, okay, you started with $700 or $1 million of EBITDA. Well, actually, we didn't need that $100,000 car. We didn't need that $100,000 salary to my, my kid's nanny, and all of a sudden we're at 1.5 million in claimed EBITDA, on a normalized basis. And so it's your job as the acquisition entrepreneur to look through those and say, do I believe those?
Do I agree with them?
Do I agree with them? Do I think that those are really discretionary expenses? Do I want to keep doing those things post-acquisition? And importantly, will a lender see these as legitimate add backs when I go to them to talk about lending?
So more specifically, let's name some common add backs that people will see.
Sure. So I'd say the most common is owner compensation. That would be, the owner, because of excess cash flow, paid themselves $500,000 a year, but you only plan on paying yourself maybe $100,000, $200,000 to start out of the gate. Well,
that's a big difference.
That's a big difference. And probably that was done because they found it more beneficial to actually pay a salary than to take a dividend. Remember, if they had taken a dividend, it wouldn't show up in these numbers at all. Mm-hmm. So those can be legitimate. The other ones you'll see is adjustments for market rate rent if they own the building. You'll see donations. You'll see things like one-time expenses where they went through a reorganization and had to pay some consultants to help them kind of sort through that.
That's not going to happen every year going forward.
One-time, non-recurring, correct.
Yeah. Okay. And so is there a way to rank these, or are they all created equal, or how should someone start to evaluate them?
So the way I go through it typically is that I like to rank them in terms of low, medium, high risk. And what I mean by risk is the risk that it's not a real add back or shouldn't be treated as a real add back. And that's because maybe it is necessary to spend the money that they're adding back to continue running the business. And so
you will still have that expense.
You will still have that, and you're not actually going to be able to save that money the way that they've represented.
Okay. And so what's a medium risk?
So a medium risk would be something like if there's a vehicle in the company. Maybe they say this was mostly for personal use. Okay, well then there's a decision you need to make. Is that vehicle something that you're going to need as part of the business that you're going to want to run through as an expense, or is really a vehicle not important to the business that you're running, and it is truly personal, and so it might be questionable whether it's necessary or not.
So if that vehicle was used for delivery purposes, doing runs, picking up supplies,
or even as simple as going to lunch with some client prospects.
Maybe that business owner went for lunch every day with the same client, and
even if you're using it only 50% for the business, what is your alternative should you choose not to get that vehicle? Maybe you're spending double on taxis and Ubers. So, again, if you need to move around, there's reasonably going to be some type of vehicle
You're likely going
expense.
to expense the
You
vehicle
got it.
similarly to the previous owner. Just an
Yeah.
example.
Yeah.
So what's a high risk item?
A high risk item would be anything that is described as a mix of business or personal, or is personal, but they can't really provide details around it. So I'll give you an example. So often we see meals and entertainment described as, or subscriptions or memberships to professional associations described as ad backs. Again, was some business development, really important relationships that the business has, the result of those memberships in those professional associations? Did it add credibility to the owner to have those memberships or those subscriptions? I would deem those high risk. The other thing I would deem high risk is where they say something's one time, but you notice it happened every year for the last 3 years. We've seen where somebody described as an ad back an employee bonus. And they said, oh, it's just an employee bonus. We just needed to keep them happy. But it happened 3 years in a row. Do you really think you're going to be able to stop making that bonus payment the year you come in? It's going to be an expectation.
Absolutely. So best practice is to review the ad backs in detail, ask questions, get the story around them, be confirmed that you agree with why they were added back and what they were attributed to. And so how are the banks looking at ad backs?
Sure. And to be perfectly clear, everybody's allowed to look at ad backs their own way. So, it is somewhat subjective. Brokers will naturally want to maximize the cash flow that they show on their marketing materials to sell the company for a high price. The lenders, on their part, they typically just don't want to do a lot of work. And I say that with all due respect to lenders, but they are doing due diligence on a number of areas. One thing they can't do and don't have the time or capacity to do is go through your conference budget and see that you stayed an extra 5 nights in Florida and add that money back to normalized EBITDA and convince their risk group that, these 20 different couple of $1,000 expenses are all legitimate ad backs.
So they're likely to say yes or no.
They're likely going to take the nice, clean, chunky ad backs, try and make a decision whether that makes sense. So owner compensation, very common ad back. Market rate rent, very common ad back. True one-time expenses, very common ad back. If they can get their heads around those, they'll do it, but they're not going to put in all the work to figure out. They're not digging.
That's your job.
That's your job. Or, we've done an episode about quality of earnings assessments that can be done by accountants. If there is a high degree of normalizations, that's going to be a red flag for lenders generally.
Yeah.
Like our opening example, if the EBITDA according to the financials is 750 and they're claiming $1.5 million in EBITDA, that's going to be a red flag to lenders. So in those situations, you're probably going to want to engage an accountant to go through the financial statements and provide that professional third-party view that these normalizations are acceptable.
So essentially in the early stages when you're evaluating a company, you're going to do the sniff test. If you like what you see, you're going to continue on. And then if you go through to due diligence and you get under offer, that's when the QofE comes in.
Correct, yeah. And I'd say to, as kind of a last point is, you don't need to agree with everybody in terms of what normalized EBITDA is. You need to agree with the seller on a price. At the end of the day, but the components that get you to that point, like they can think EBITDA is 1.5 million, you can think it's 1.2. That's not insurmountable, and you don't have to negotiate over that. You just have to understand that they're going to see the multiple a little bit different way, and if the bank thinks that EBITDA is $1 million in that scenario, your lending is going to be constrained to that $1 million. So as long as the deal structure works with all those things in mind.
So there's quite a few moving parts here. 1.5 to 1.2, that difference there, you throw a multiple on that, and sometimes that price differentiation can be quite substantial, and you've got to get over that in negotiations, and you've got to get the bank on board. So quite a few moving parts. So to confirm what you had iterated as well is you don't have to agree with it, challenge it, confirm them, but essentially negotiations will kind of solidify things at the end of the day, and cash flow is not always what it's cracked out
No, I
out
think
to be.
the myth is busted.
Myth is busted.
And you know, at the end of the day, you're going to be the one wearing the risk and, you know, owning this company. So it's your number that's the most important and what you think it is. So just make sure you're comfortable with the deal at that number.
Do the diligence.
Correct.
Myth officially busted. Thanks, Eamon. That was a great session.
All right. See you next time.
Thanks for tuning in. If you enjoyed the content, please be sure to subscribe, follow us on social media, and check out our website at villagewellth.com.